Hey, good morning. Good morning and welcome to this Wednesday, December 15th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've got the Fed on deck. They started their meeting yesterday. Today at 2 o'clock, we'll get the latest from the Fed. And it's going to be a pretty interesting day because we'll talk about this a little bit later, but the Fed really has two mandates. One is to maximize employment. And of course, we've got our unemployment rate back down close to or at multi-decade low. And then their other mandate is to stabilize prices. And of course, you can't really get away from the fact that we have seen rising inflation in terms of both at the consumer level and the producer level. And it's going to be interesting to see how the Fed tries to navigate around this today. And whether they finally cave and start talking about raising rates. I certainly wouldn't expect a rate increase today, but they could ramp it up a little bit earlier, and they could start looking at raising rates perhaps in the first half of next year, which is a far cry from just 6 months ago when we were talking about not getting any rate increases until perhaps the latter part of 2023. So that's going to be the big news today, no doubt. Not that inflation is anything new. The Fed is generally very transparent. It's talked about inflation being transitory in the past. It's just really how they modify their wording, and that's what the market's going to be looking at today. If it spooks the market, we will probably see a sell-off this afternoon after the meeting, and growth stocks, which have been getting hit hard on a relative basis, I would suspect they'll continue to do so. But if the Fed sticks to its guns and says, okay, we made a mistake, transitory, we were talking about transitory, thought it might be a few months. Well, it's going longer, but we still believe it's transitory. That could be something that really gets the market going back to the upside, especially the growth stocks that have been hit of late. So anyway, that's the big news for today. And we're going to talk about that some more as the show goes on. But first, let me take you all over to Earnings Beats. And if you are new to Earnings Beats, welcome. If you've been with us for a while, thank you for your support. Those of you that are new, though, simply go to earningsbeats.com, scroll down, you'll see a free newsletter that we offer. This is the best way to get to know us. I mean, coming in here to the shows, reading my blog articles over at Stock Charts is a great way as well. But this is a newsletter that I publish 3 times a week, Mondays, Wednesdays, Fridays. Normally out by about 8:30 or so. Try to get it out a little bit before the opening bell on those 3 days. There's no credit card required. You can unsubscribe at any time. So literally all it takes is a name and an email address, and you can become part of our community, our growing community. We have a lot of free events too, by the way. And one of the benefits of being on this newsletter is that when we have free events, we send out room instructions to this community. So that's another reason that you want to be part of it. All right, let's move on and talk a little bit about what happened yesterday. So again, yesterday was the first day of the Fed meeting, and we got another hot inflation report. The PPI came in much stronger than expected, and we've seen that year over year increase now continue to move to the upside. The bad news is that while inflation's become a problem, we've really struggled this year with the growth stocks. That area of the market has struggled. Large cap growth, not so much. Apple, Microsoft, these types of companies have tended to do pretty well. But when you get beyond that upper tier and you move into the mid caps and the small caps, that's where the growth stocks have really struggled. And if you've traded those throughout 2021, and we have in our portfolios to some degree, that's where you really see the impact. That's why when you look at a couple of growth ETFs that historically have done very well over time, Kathy Wood's ARK funds, the ARKK, and then also all of the ARK funds. I think they're all struggling, but the ARKK is one that I watch pretty closely. And the other is the Innovator 50, the IBD, FFTY is the ticker symbol. I mean, if you look at those two, you'll kind of get a sense for what's going on in many of the growth names underneath that large cap level. Because unless that's all you're trading, large cap growth, you're probably struggling to outperform the S&P 500 this year. And it all relates back to rotation. But I remember back at the beginning of the year, even the end of 2020, or at the end of 2020, I remember talking about how I was still very bullish. I thought the market was going higher, but rotation would be the difficult part, trying to figure out, which area of the market is leading when. And that's been true throughout this entire year. That's been the really difficult part. And I don't think it's going to end anytime soon. I really don't. I think probably the next 6 months, I think beyond 6 months, I think we're going to start getting back to a more normal market. But these next 6 months, I think, especially with this inflation, how it plays out, what the Fed does, how the market reacts, I think that's going to continue to be the theme here in the short term. Anyhow, Dow Jones yesterday down 106 points, S&P down 35, NASDAQ down 176, mid caps down 13, small caps down 8. So on a percentage basis, once again, NASDAQ taking a bigger hit, back down close to the lows we saw in early December. You can see the S&P still has a little bit further to go, and the Dow really hasn't backed off much of late. And that kind of underscores that value theme that I've been talking about of late. Mid caps, small caps, kind of like the NASDAQ, both kind of moving toward the earlier lows in November. But all 5 of these indices, as far as I'm concerned, remain in an uptrend. So if there's one thing on these 5 charts that bothers me a little bit, it's the AD lines on the mid caps and the small caps. What I'm seeing is a lot of distribution right now in these areas. And we probably need some clarity from the Fed on what's going on, some assurance. If we don't get that, I think this probably continues. I think this is probably the area of the market that's going to struggle the most. But I believe in 2022, we're going to have a massive rally in some of these small and mid-cap names. I'm beginning to see it more and more, but I'll talk about that later. As we get into the new year, I'll also be talking about it a lot at the Market Vision 2022 event, which is scheduled for Saturday, January 8th. We haven't really published a lot of information about that yet. I've just talked about it the past few days. We'll be getting more out to everyone soon. Got some good news about those who can attend. We'll be talking about all of that coming up. The financials led the action on Tuesday. Financials up 0.6%. Staples, the only other sector in positive territory, just rising fractionally. But you can see Staples actually has made a breakout of late. I don't have the consumer discretionary up here, but I can tell you the consumer discretionary is not breaking out right now. That's down probably close to 8 or 9% down from its high in November. So the consumer names right now, definitely money is rotating towards Staples versus discretionary, but the market's been choppy. So, we normally see some of that. But the inflation scare, I think in the short term, is definitely going to continue to be the issue there. Technology had a rough day yesterday. Negative divergence on this latest high. We got a bearish engulfing candle. I believe that was a bearish engulfing candle day before yesterday. And that occurred with a negative divergence. So I'm not at all surprised we saw technology go lower. I think, unless the Fed gives growth stocks some kind of a big boost, I'm not sure they're going to. I think we're probably going to see a little bit more of a sell-off in the near term, especially some of the large cap growth names. I wouldn't be surprised if Apple were to get hit further. I'm going to talk about Apple as it relates to Max Payne in just a few minutes. But right now, technology looks to me like an area that could be exposed to some more selling. Real estate, I think, looks pretty good. Again, this is a defensive group. So like Staples, you got the breakout there. Real estate got the breakout. Both PPOs look pretty good. So in the short term, while all this craziness is going on, and I wrote about this, I don't know, probably sometime last week, I think the safest thing to do is kind of stick with these defensive groups until the dust settles. I think that heading into options expiration Friday and maybe even into early next week, we may see a nice rebound in some of these growth names. But I think the safer play is the Staples, real estate, utilities. I know it's all kind of boring. Probably going to see the 10-year Treasury yield tick higher, although we haven't yet. But if we do, maybe the financials continue the strength that we saw yesterday. And then finally, the last group on this page is just the industrials. Getting hit pretty hard. So technology, real estate, and industrials, those were the three that were down the most yesterday. Moving on to the 10-year Treasury yield, we did have a big economic report out this morning. If you didn't see it, it was November retail sales. They disappointed. I'm not surprised that they disappointed, but retail sales came in with a rise of 0.3%. The market was expecting 0.8%. I believe last month, October, we saw a rise of 1.7%. So retail sales slowing back down, but really what we've seen with retail sales is just this up and down. It's been a yo-yo, very disappointing, and then a blowout number, and then disappointing, and then a blowout number. And so this month we're seeing a little bit of disappointment, but it is positive. So I guess that's good. It kind of puts when I start seeing reports like this, to me, it puts the Fed in a little bit of a box, because, I guess some might think that we need to start raising rates because of inflation. But at the same time, if the economy is not as strong as what we think it is, or if it's just being boosted more by the, coming out of the pandemic, and it's not a sustainable recovery, the Fed doesn't really want to raise rates. So you might think you need to for inflation, but you're not quite so sure with the economy. So again, it's going to be very interesting to see what the Fed has to say later this afternoon. If we strip out autos, November retail sales also rose 0.3%, trailing the estimate, which was a rise of 0.9%. December Empire manufacturing, state manufacturing, came out this morning hotter than expected, or better than expected, 31.9 versus 25.5. And then later this morning at 10 a.m., we'll get the December housing market index. November was 83. We're looking for that number to jump up to 84. And then last thing, of course, the Fed. Their meeting ends today. The policy statement comes out at 2 p.m. Eastern. We tend to have craziness after the 2 o'clock announcement. I think today could really be crazy, depending on what they say. Because sometimes with the Fed, it's not so much what they say, it's how the market interprets their credibility. At least for me, that's what it's all about, because the Fed tries to lay out in advance what they're going to be doing and what they're thinking about and what they're seeing. So they try to be very transparent. And so when they announce at 2 o'clock, we don't typically see a whole lot of movement. We get the knee-jerk reactions, but, I did an article, and I'm going to move into that here now. So I did this article back in September, showing how Wall Street has reacted to the Fed in the last 10 meetings. Now, that was right before the September meeting. And then, of course, we've also had a November meeting since then, and now we've got the December meeting. But if you go back and you take a look, and down here in this table right here, what I've done is I've shown the date of the announcements. So going back to July of 2020, all the way through July of 2021, I showed where the S&P 500 was at the time of the announcement. And then I show the day of the announcement, the high and the low intraday on a percentage basis. And you can see the averages, 0.4% to the upside, 0.4% to the downside. And then a week after the announcement, I went back to see how much the S&P 500 had moved from where it was prior to the announcement, how much it had gone up, how much it had gone down to the high and to the low, and then where it had closed relative to the announcement. And what you see here is a week later, you can see a little bit more volatility, the high and the low, but the close was still not really much changed on average from where the Fed, or where the S&P was before the announcement. And I think the reason for that is that they do a pretty good job of being transparent. So when they come out with the announcement, they're not really telling us anything we don't already know. So I think for the most part, these announcements are more fluff than anything else, because we already know the information they're going to share with us for the most part. This one is maybe a little bit different. And if you notice, back in 2020, most of the volatility was in 2020 coming out of the pandemic. We didn't know what to expect. We didn't know what was going on. If you looked at the last 4 meetings when I wrote this article, we saw very little movement in terms of even a week over the course of the next week. But right after the announcement, we saw almost no volatility And even a week later, not a whole lot of volatility. So I think the Fed was doing a better and better job of making the market aware of what potentially was in store, what was coming. So I wanted to show you the S&P 500. This is a 3-month chart. And the whole point of this chart is to show you the last 2 meetings, what has happened. So that was a table that took us through July of 2021. So we had a meeting September 21st and 22nd. So this was the date of the announcement. So we closed at about a little over 4,400, it looks like, or maybe just under 4,400. 5 days later, we were sitting, just a little below 43.75, I believe, if I can, yeah, looks like. So it was less than 1%. We went up for a little bit, and then we came right back down and finished almost unchanged, a little bit lower than where we were at the time of the Fed announcement. The last meeting we had was in November. It was the 2nd and 3rd of November. This is the candle for the 3rd, and you can see where we were. We were at about 46.60. Went up a little bit over 4,700, so maybe up 1%. Came back down, closed at 46.40, 46.45, something like that. So once again, not much change. So this is 6 meetings, the last 6 meetings in 2021, a week after the Fed announcement, were basically unchanged. It's going to be very interesting to see if this one holds the same, for me anyway. I just see all the rotation, and maybe what we'll see is the Fed, maybe it'll be a relief rally, just getting past the Fed meeting and the Fed just kind of maybe not throwing any major curveballs to the market. That's what I'm hoping for. The Fed has said, hey, we're thinking about, the repurchase program, all these bond purchases, we're slowing them down. Well, remember, a lot of that program was to maximize employment. Well, we don't need that anymore. We're there. Our unemployment rates come down, like I said, to a multi-decade low. So we don't need to maximize employment. What we need to do is stabilize prices. So the things that they had in place to help the economy are the things that they really should be getting rid of. And so I'm looking for this afternoon for the Fed to be talking about maybe even stepping up the pace of this free money for the market, because the market doesn't need it. And that in turn should allow the bond market to naturally begin to move a little bit higher, the yields, not the bond market, but the bond yields, because they're going to slow down their purchasing. Well, if you have fewer purchasers and the same number of sellers, then we should be looking at bond prices going down, which sends the yield higher naturally. So I think that's where the Fed's going to focus. I don't know that the Fed is going to, maybe they're going to talk about moving up the rate hike. I don't know. Personally, I'm hoping that they don't, because I don't think it's going to be necessary. I really believe inflation, once we get beyond, and I wrote about this a couple of days ago over the weekend, I think, but I think once we get by the middle part of the year, I think inflation is going to naturally start to come back down. Now, I don't have an MBA or PhD in economy, economics. So, I tend to think I follow a lot of the stock market, a lot of the historical news and how it impacts the market. So I think I have a pretty good sense, but, I don't sit on the Fed, and I'm not making policy decisions. So we'll see what the Fed does. But I think we're going to see inflation peak. I don't know if we've peaked yet, but I think we're going to peak soon. And I think starting in about March or April, I think you're going to start seeing that annual rate tick down. And that is when I expect growth stocks are going to explode to the upside. Trying to predict when, because if the inflation starts to tick down in March, April, maybe even May or June, that doesn't mean that the stock market's going to wait until then to start buying growth stocks. The market looks ahead. So, it could start now. It could start in a couple months. I'm not quite sure the timing of it, but I do believe, and history bears me out on this, when inflation starts moving back down, growth stocks take off. Inflation's been going up, and that's the problem in 2021. And that's what's been holding back these small cap growth and mid cap growth stocks. 2022, I think, is going to be a different story. I think it's just the timing. So anyway, got a lot to talk about at Market Vision 2022. My gosh, that's going to be a very interesting day for sure. So mark your calendar again, January 8th, and make sure you're available. Even if you're not available to attend live, we do send out our recordings for the event. All right, let's keep moving on. So I wrote this article about fireworks in December, monthly options, and I just went back and talked a little bit about Zoom and how the options world works. If you're not familiar with options expiration, the monthly options expiration, you should become more aware of it, especially if you like trading stocks and you just trade haphazardly throughout the month. You need to know that the third Friday of every month, monthly options expire, and you need to know the potential impact of that. So Zoom, which had gone down for 2 straight months, a little over 2 months, from 400 down to 255 back on October 12th, had a ton of in-the-money puts, a ton of in-the-money put premium. And so what that meant is just options traders were buying puts, and they make money as the stock goes down. The problem is when they're buying the puts, who's on the other side? Usually the market makers who are writing those puts and are those contracts and are on the other side of those. So as now, they can short the stock, they sell the put and then they short the stock. So they're protected to the downside by shorting the stock. But if they cover their short and begin buying the stock into options expiration, they make the money on the short side, they make the money on the long side as it bounces, and they cut into all that premium. They can make so much money. There's so much incentive. And they can't always, they don't have unlimited resources. Market makers, they don't have the printing press like the Fed. So they can't, sometimes you need the market to kind of sell out on its own. And then once things start to settle down, and especially like in this case, we had a little bit of slowing momentum, price momentum on Zoom, it becomes easier to start manipulating prices in the short term. So Zoom went down to 255. A couple of weeks later, it was 291, went all the way back up to 291. 1 week later, it was at 280. A lot of the $175 million of net in the money put premium, a lot of that disappeared over the course of the next 2 to 5 days. So that's the key, and that's the part that you need to be aware of. Now, when I talk about options, I'm just going to take you into the CBOE.com because Apple has made a big run. And I talked earlier about the fact that technology could pull back further and that Apple could be the culprit. And I was going to talk about it later. Well, this is what I'm going to tell you. If you go to CBOE.com, you click on data. And for those of you who are members, we do this with our Max Payne session, which we had last night. If you're not an Earnings Beats member and you're not familiar with this, you probably should join us and just come into one of our Max Payne sessions. But anyway, go in here, click on this quotes dashboard. Now we want to look at Apple. So let's pull up Apple, hit the search. And then it brings up market snapshot and all. We want options. And then what I want to do is just make sure I have the standard filter there, which is the monthly. You've got all the volume, and also I don't want just near the money. I want all of the options and then view the chain. So this is going to tell me everything that's outstanding for the December monthly options for Apple. So it gives me all the strike prices and it gives me the open interest at each strike price, number of open calls and the number of open puts over here. So right here, you can see puts. So all of these columns over here deal with puts. Here you see calls. All of these columns over here deal with calls. And there's the open interest column, open interest column. So as you look at Apple, right now, Apple's trading at 170 or 160 some, I think, or no, 174. If you look at the number of in the money calls, so as the price has been going up, you got a lot of traders that keep buying calls. They're going with the momentum. So we're sitting at 174. There's 79,000 calls at 150, 69,000 at 155, 69,000 at 160, 29,000 at 165, 44,000 at 170. Every call gives the holder of that call the right to buy 100 shares of Apple at this price. That's a lot of in the money call premium right now. All of that. Look at the put side. Now, these are the folks that are benefiting if the price, let's just say Apple's at 175. The only way you're making money right now on the put side is if you're holding puts with a strike price above 175. 16,000, 11,000. So do you see how there's very few in the money puts and there are a ton of in the money calls? Well, as prices move lower and lower, the number of in the money calls shrinks, the number of in the money puts increases, and you get to a point of equilibrium where there's no value on either side. They offset one another. That's max pain. That's the max pain. That's where you put the most retail traders in pain as you can possibly get. Right now, you got a lot of really happy campers on the long side holding all these calls. If Apple were to drop $10, there'd be a lot fewer happy campers on Apple. And so, when you look at Apple on let's go over to the stock charts and let's just pull up the chart for Apple. So when you're looking at Apple, I think I might have said I did say XLK had a bearish engulfing candle. Apple right on the top had a dark cloud cover. That's a reversing candle. And sure enough, we came down yesterday. If the Fed doesn't help these growth stocks, and even if they, there's a little bit of good news in there, I'm not so sure it's going to help Apple heading into option expiration. We'll see. But just a normal 20-day test would be another $8 to the downside, which would really help market makers. Not that they need a lot of help, but anyway. Let's move on. I just wanted to talk quickly about the healthcare and healthcare potentially making a breakout here. So if with the Fed meeting this afternoon, the market does turn more defensive, watch the XLV. This is a defensive group. I think, we could be on the verge of a breakout here. We already said Staples broke out, real estate broke out. Those are two defensive groups. Healthcare is on the verge. As we go through all this choppiness and rotation and Fed speak and inflation and blah, 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 a lot of money is rotating into defensive areas. So this, in the short term, is a little bit more of a safe haven. So you might want to continue to watch the XLV. Within the XLV, the one group I think that's starting to show a lot of strength is healthcare providers. This is a 3-year relative chart, healthcare providers divided by the S&P 500. And you can see right now we're at about a 4 or 5 month relative high. If we haven't already made it, we're about to go to about a 6-month relative high. So healthcare providers are starting to look much better. So that's an area that you might want to concentrate on. All right, earnings real quickly, just a couple of companies out this morning. ABM is the first one. AD line looks horrible. It's been sideways consolidating. They did beat this morning, 85 cents versus 80. However, it's flat. Last time I looked pre-market, it was flat. Not flat are two others, though. TTC, which is Toro. This one has been going down. They did beat slightly, 56 cents versus 55. Stock up 4% pre-market, so it's going to be somewhere in here. I still think it's in a downtrend. I'd be careful chasing a gap on that one to the upside unless it can break out. And then REVG, which is REV Group, been going sideways. Look at the relative strength of the stock versus its peers, just been flat versus the S&P, been trending lower. They missed 27 cents versus 29. Stock's down 8% pre-market. So it does look like this overall downtrend is going to continue. All right, the three you must see. Let's wrap this thing up. Here are the 3 Dow stocks that performed the best yesterday. Thought we'd just take a quick look. Travelers going sideways, really need to get a breakout above 163. Until we see that, just in a trading range. Merck has not been a very good performer of late, but it does look like maybe at least in the short term, trying to find some support here closer to the 70 level. Move back up to the 20-day is what I would expect here. And then the last one is J&J, Johnson & Johnson, which you can see the AD line picking up with this move to the upside. So Johnson & Johnson in that pharma space. Pharma is also, in addition to healthcare providers, starting to show a little bit of strength. You can see it here with this breakout above the November high. Starting to see a little bit of strength in the pharmas. And right here, you can see on a relative basis, moving up to about a 3-month relative high to the S&P. So within healthcare, if we get the breakout, pharma is looking pretty good. Also, the healthcare providers looking pretty good. And you can see J&J actually making a breakout. So if I looked at something like J&J versus Merck, I'd be more interested in a J&J. I think the AD line looks better. The price breakout, we're above the 20-day, which is above the 50-day. Merck was the opposite. So this one looks better to me. All right, that is it. Market just opened about a minute ago. Let's get a quick look at that, and then we'll move on, wrap this up. Yeah, Dow down 3, S&P up 4, NASDAQ down 1. I mean, couldn't get, S&P small cap 600 up 0.1 points, not percent. You can see 1/100th% to the upside. Mid caps not doing a whole lot more. So right now, pretty flat. This is about as flat and open as we've seen in quite a while. We'll see what happens, but we do have that Fed meeting coming up at 2 o'clock. Going to be an interesting day, no matter how you slice it. Let me just be clear about one thing. I remain very bullish the market going forward. I do not believe inflation is a problem. I wrote an article recently to follow certain charts. If you believe inflation's a problem, there are a few charts that you can watch to really see if it's a problem based on what Wall Street's telling us. Wall Street is telling us inflation is not a problem. So personally, I would tune out the noise. I would not listen to the analysts that are talking about inflation. Let's listen, see what the Fed does, and then let's see what the market does in reaction. Follow where the money's going. Don't follow what people are saying. You don't know what their agenda is and what they're, some of these analysts that are working for Wall Street firms, I feel like they're puppets. That's all. I mean, if I was Goldman Sachs and I believed the market was going to go higher, wouldn't I want to buy stocks cheaper? I mean, don't you kind of want to instill a little bit of fear? I mean, you don't know for sure the market's going to go higher. So why not just talk about all the negatives that are out there? I mean, and things that could go wrong. And I just think we're flooded with that. And that's what captures everyone's attention in the headlines. Just be careful. Follow the charts. Follow the charts. That's all I'm going to say. All right, that's it. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. I also want to say we're going to be going into a holiday schedule here at Stock Charts, not at Earnings Beats, but at Stock Charts with these shows over the next couple of weeks. So you're probably going to see a number of evergreen shows, which are previously recorded shows. That as we get into holiday season, it's just much slower. So I don't even know if next week's shows will be live shows over at Stock Charts. They may all be evergreen. There's still some discussion there, but I just want you to know ahead of time that could be the case. Anyhow, listen, everybody have a great day. I'll be back tomorrow for your next Trading Places Live. Happy trading.